right, so we've got these guys unmuted. Tommy Barro is joining us in a couple minutes as well. He's working hard on somebody's loan, I am sure. Hopefully everyone enjoyed Marty's little presentation and the introduction that we started the day off with. So what we're going to talk about now is getting a loan. So, and everything way more than that. Finance is, as I mentioned, kind of the key to this whole piece. And depending on what type of property you buy and what your income situation is and your living situation and what your capital allocation looks like and all this fancy stuff, your financing is going to be different on every single deal. So we have an excellent group of 3 experts that we've worked with over the years. And these guys go from everything that like an investor owner occupied duplex all the way up to huge apartment buildings, all in the multifamily space. And so if you've been in the industry already over the last year, lending's been really interesting. A lot of changes, a lot of unexpected things have happened. I'm sure everyone knows interest rates are super low right now, which is odd, right? Considering what's going on. And so we need to unpack this a little bit and figure out what the differences are between different loan products, where the market's going, what's changed. And so I can't think of a better group of people here to do that. So we're going to kick it off. I'm going to invite David Guevara to tell us a little bit about what segment of the real estate finance industry he specializes in, just kind of deals that are out there and what he's seeing right now. And then we'll get into some detailed questions in a minute.
Awesome. Thanks, Anthony. Hey guys, I'm David Guevara. I work with Momenta Capital Group. We focus primarily on 5+ unit apartment buildings and focus mostly within that specialization on local multifamily bank loans. And so we have a group of anywhere between 50 to 60 of the top nationwide bank lenders, and especially in the Southern California area. And that's the bulk of what we do is multifamily finance, 5 to 50 units, primarily with bank portfolio loans.
Nice. And Andrew, how about you?
Hey, Anthony. Thanks for having me. It's a tough gig to follow Marty. I wish he could just stay on and tell more stories because that was great.
Busy being mostly retired.
Yeah. I was at a 4-year-old's birthday yesterday. So it was a bounce house and a whole lot of fun. So I'm sure they'll have a blast today. But for those that don't know me, my name is Andrew Westling. I'm with a firm called Walker & Dunlop. Walker & Dunlop is one of the largest commercial real estate finance firms in the country. In 2020, our market share of total commercial real estate lending in the US was 8.8%. And our market share of total multifamily lending in the US was nearly 11%. What we do is we wear a few different hats for our clients. First and foremost, we are a direct lender for Fannie Mae, Freddie Mac, and HUD executions for all things multifamily. Last year, we were #1 with Fannie, actually for the 6th time in the last 9 years, and #4 with Freddie Mac. And we've been #3 or 4 with Freddie every year for the last 8 years. The second hat that we wear is we are a correspondent lender, meaning that we represent more than 36 life insurance companies originating debt on their behalf and then servicing the loans for the life. And then the third hat we wear is we are a broker to all other third-party capital providers like banks, credit unions, debt funds, CMBS lenders, et cetera. And so we have a wide swath. We cover the entire debt and equity markets for our clients. Typically, we work on loans of $1 million or more. Actually, our Fannie and Freddie platforms have a minimum loan size of $1.5 million. But for some perspective, I can tell you that my team here in LA, our average loan size last year was about $7.5 million. The smallest deal that we did was $750,000. The largest in 2020 was $31 million. Although just last week, we closed the second largest transaction in my career. It was a $120 million loan on a single property here in Santa Monica. And just as a reference point compared to the rest of the company as a whole, also in 2020, we closed the largest single transaction in our company's history. It was a $2.4 billion transaction. Yes, that's with a B, for Southern Management collateralized 67 multifamily properties in the Washington, D.C. area. So moral of the story here is that there's no transaction too large and really no transaction too small for our platform. And just as a side note, I should mention at Walker & Dunlop, we do finance all property types. But of course, as this being a multifamily panel, we'll just be focusing on that asset class today. So thanks for having me.
Awesome. Thank you, Andrew. And I'm sure Tommy was working hard on somebody's loan before hopping on right now, but he's just joined us. So Tommy, we're just doing introductions and talking a little bit about what space of the real estate finance market you specialize in.
Perfect. Thanks for having me on. Yeah, my name is Tommy Barro. Company is First Centennial Mortgage. We primarily focus on 2 to 4 unit residential financing. All products in the residential space, VA, USDA, conventional, and FHA. Primarily in the 2 to 4 unit space, we usually look into FHA, VA if they're eligible, and conventional. We're a direct lender as well. We have our own appraisal panel, which can be important on multifamily investing, which we'll talk about a little later. I've been working with Anthony and his group, I think, since 2009 on their residential stuff. Yeah, I've been a top producer for our company nationwide for the last 7 years, and do a lot of purchase business, specifically multifamily South Bay area. Long Beach has kind of been our specific niche. And other than that, yeah, we'll get into more detail as we move along.
Awesome. Thanks, guys, for the introduction. So hopefully you can see we've got every bit of the spectrum here for what you would need to finance a apartment building deal. Before we move on, all of these gentlemen have provided us with some materials that can be downloaded. And I've just put the link to the session page for this particular panel discussion in the chat. So we've got some little job aids, formulas for you and stuff like that, because if you're hearing about this for the first time, lending is one of those spaces where there's probably more acronyms and terms than any other part of the business. So if your head's swimming with terminology, check out the downloads and we can try and help everybody understand. Feel free to enter questions into the chat as we go along. This is all going to kind of be an interview. And we're going to sort of go through each of these types of finance. And we're going to talk first about just what sort of terms we might see on each of these areas. So Tommy, I'm going to start with you since you do the residential stuff. I think, you know, we've got the owner occupied side of things on the 2 to 4, and then we have the investment side of things on the 2 to 4. Maybe can you start us off, like what would we see as far as like down payment rates, stuff like terms on each of those if somebody were calling you today to try and finance an apartment building?
Sure. So I'll start off with FHA because that's going to give you the minimum down payment option. But on a 2 to 4 unit space or product, you can do as little as 3.5% down with an FHA loan. There's loan limits as you progress. So like a 2 unit, your max loan amount is $1,053,000. And it goes up from there. I think 3 unit is 1.271, and then a 4 unit is 1.498 or something like that. I'll get those numbers specific here. With FHA financing, again, minimum down payments 3.5%. Rates are still fantastic. Rates are going to be probably in the mid to upper 2s on that. You do have 2 different types of mortgage insurances with FHA. You have an upfront mortgage insurance premium, which gets added to your base loan amount and is paid over the 30-year term. And then you have your monthly PMI. A little nuance with FHA is on 2 units, it's all about your individual borrower qualification. So they're going to look at your debt to income ratio as it relates to the property's payment and overall personal debt that you have. When it comes to 3 and 4 units, on FHA, there's another layer there, which is called a self-sufficiency test. This is a big thing when you're financing FHA on 3 to 4 units, because regardless of your qualifications, the property has to pass a self-sufficiency test in order for FHA to lend on the property. And just a real brief kind of excerpt on that is Essentially, the appraiser is going to give his opinion of market rents for all units in the building. So if it's a 4-unit building, he's going to give his opinion of market rents for each of the 4 units, regardless of the unit you intend to occupy, which I'll explain a little bit of that as well on that. His opinion of market rents. So let's say he gives $1,500 a door, so the building gets $6,000 in market rents per month. 75% of that's $4,500. The monthly mortgage payment cannot exceed that. If it does, we've got to put either more money down or FHA won't lend on it. That's only pertains to FHA and only to 3 and 4 units. On the residential or on the conventional side of 2 to 4 unit investing, there still is a program, but it doesn't really apply to California borrowers. There's a program called Freddie Mac Home Possible that allows you to put 5% down on a 2 to 4 unit property. The problem with that is that you can't make more than $60,000 a year, and that includes the rent that the building would generate. So it makes it almost completely unfeasible in the state of California. So outside of that, really conventional financing limits you pretty heavily. You have to put 20% down on anything 2 to 4 units if you own or occupy it. If it's a non-owner occupied, like Anthony kind of alluded to at the beginning here, then you have a 25% down minimum. That's just the way it works on 2 to 4 units. And they're looking at your personal debt to income ratios.
But you get to count the rent from the building too, right?
Correct. The existing rent, the current rent as part of your qualifications. We used to have investors that allowed market rent qualifications, but now with all the stuff that's going on in California, they've kind of removed that in the past year for being able to do that. I will say FHA financing is not only a first-time home buyer loan. It's labeled as a first-time home buyer loan, but you can own other properties and still use FHA financing. The caveat with FHA is you're only allowed one FHA loan at a time. So if you have a loan or property with FHA financing, you won't be able to do another one. But FHA is only for owner-occupied intentions. So conventional financing will give you the ability to look at owner-occupied as well as investment holding.
Awesome. And what rates would we see right now for a non-owner occupied 4 unit, something like that?
If you did a non-owner occupied 2, 3, or 4 unit with 25% down, you're looking at 3.5% today.
Okay.
Which is up a little bit from their lows. I think the low was at like 3 1/8 with no points. Now you're looking at about 3.5, which is still a really great long-term fixed rate.
Really good.
Oh, and that's the other thing too. On both FHA, or not so much FHA, but on conventional, when you get into the multifamily space, believe it or not, the 30-year fixed pricing is the best interest rates out there. It's better than any ARM pricing. It's better than any interest-only pricing for the few banks that even offer that interest-only feature on multifamily. But residential is all about risk aversion for rates. So the longer the term, the longer the amortization period, the more aggressive the rate is, which is why the 30-year is actually even better than a 15-year fix, for example, on multifamily properties, non-owner occupied.
Interesting. Okay, great. Let's move on up the size spectrum and we'll go to David next on this same question. What are we likely to see on terms, rates? I know it's different with what you do.
Yeah, so there's a couple of differences. First of all, the one of the main differences to keep in mind is that because most of what we do is credit union and bank financing, each individual bank and credit union some of them are selling their loans to other banks on their credit unions and potentially to Fannie and Freddie. But for the most part, these are portfolio loans, meaning that the banks and the credit unions are keeping the loans on their own balance sheet. And so they set their own internal terms, rates, conditions, and stuff like that, guidelines, underwriting criteria, and stuff like that. And so when I'm speaking somewhat generally about what I'm seeing across the whole banking platform in Southern California, but just note that there are nuances and that there are certain things that one bank might not accept, but another bank might. And so when I'm speaking about terms, it's kind of a generalization rather than exactly what you're going to get, like you would with a loan that automatically is going to go to Fannie and Freddie. Now, with that said, we're typically seeing 5-year fixed, 3, 5, 7, or 10-year fixed rates. There really are no 30-year fixed options for this particular space. There's a couple in the much larger spaces, and Andrew can touch on that in a little bit. But for the most part, you're looking at a 3, 5, 7, or 10-year fixed. Usually the 5-year fixed tends to be the sweet spot locally. And those rates are right around between 3.25 to 3.5 right now. Another big difference that you're going to notice between residential 2 to 4 unit financing and 5+ unit financing is that you'll have prepayment penalties. Prepayment penalties are essentially a bank's way of discouraging you from paying off a loan before the fixed period expires, so that they can essentially ensure a certain return on that note. And so something that's typical is for banks and credit unions is a step down. So if your loan is fixed for 5 years, typically if you were to pay it off in the first year after the loan was taken out, you're looking at paying about 3% of the balance as a penalty. After that, it starts declining. So usually it's 3% in the first 2 years, and then it drops to like 2 or 1% thereafter. And once the fixed period expires, there's no more penalty to pay it off. Because the idea is that investors are typically going to want to exchange their properties or refinance them every 3 to 7 years. And so that's kind of the purpose of prepayment penalties. So the two major differences are you're going to have a shorter term fixed period. So like it's going to be an adjustable. So 5 year, 3, 5, 7, or 10. And then you're also going to experience prepayment penalties. The rates, like I said, are in the low to mid 3s right now. And then the other major difference is that whereas residential loans are underwritten based off of the borrower's DTI, debt to income ratio, commercial loans that fall in the 5+ unit multifamily category are going to be underwritten primarily based off of the property's debt service coverage ratio, which essentially is the difference is on the residential side, banks and or Fannie Mae and Freddie Mac are looking at the borrower as the primary source of payment for the debt, whereas on the commercial side, banks are looking at the subject property as the primary source of repayment for the debt. They also sometimes look at the borrower as a secondary source of repayment to make sure that there's enough liquidity, that there's enough net worth, that there's good credit, and that there's potentially a secondary source of repayment through a second source of income. But the primary underwriting goes on the subject property to make sure that the subject property can support the debt.
So that brings up, we had a question in the chat about that. So, a lot of what you hear about the difference between commercial and residential lending is like commercial, it's only based on the building. So if you have the cash and you can do the down payment, you can buy it and you don't need income. Is that true, or is it more complicated than that?
Typically in the bank space, and Andrew can talk more about in the agency space and the life companies, but in the bank and credit union space, almost all bank and credit unions are going to want, or I should say all bank and credit unions are going to want to see some sort of secondary source of repayment. Now, that doesn't mean that there's always tax returns provided to verify that income, and that banks are very, very strict about making sure that everything tallies up and asking for check stubs and stuff like that. But they do want to see that there's secondary sources of repayment besides the subject property. Now, that could mean you have other properties that produce cash flow. It doesn't mean you have to necessarily have a day job. You could have other investments that produce dividends every year. You can have certain other, basically any other kind of income. But typically, every bank and credit union right now, especially, is going to really want to make sure that there's some sort of secondary source of repayment. And they're also really wanting to focus on making sure that people have liquidity. And I think that was that was something that once COVID hit, banks really started dialing in on even more is being strict on liquidity to make sure people have a reserve.
So Kathy brings up another good question. So what about down payments? 25?
Okay. So down payments, typically what we're seeing is the minimum down payment is 25%, but because these properties are underwritten based off of their cash flow, if you make $1 million a year and you want to buy a $750,000 property, you can't just put necessarily 25% down on a 5 unit for $750,000 or for $1 million. By the way, if you find a $750,000 5 unit in Southern California, give me a call. But Yeah, so it's 25% down typically. But you have to make sure that the property's cash flow can support that loan amount. So if you have a property that you're buying that has a lot of upside, or it's in a very low cap rate area, then you're probably gonna have to put a lot more down, 30, 35, 40% down. It's not rare for us to see borrowers having to do that. Now, with that said, there's also, I've been, I don't know if it's lucky or not, but we've had quite a few 75% loans that we've done in the last 6 to 7 months. And I think a lot of that is because they were priced because of COVID.
Right.
And so, yeah, we've been seeing a little bit of that. It also helps that rates are low because they're underwritten based on lower rates. So, a 5 cap at 4% is probably not going to get you, you're probably gonna need 30% down, but a 5 cap at 3.25% is gonna get you that 75% you're looking for.
Awesome. Okay, so Andrew, in your space, what sort of terms would we see on the typical loans that you're doing? What differs from David and Tommy?
Sure. So I'll speak, let me talk about Fannie and Freddie first, because I think that's just, they are such a big part of the market that they command their own piece. And I can touch on life companies a bit, but for the purpose of this, let's focus on Fannie Freddie. So Fannie and Freddie are multifamily lenders. They are quasi-government agencies. They were put in place to ensure that there was liquidity for buyers and investors of multifamily to go out and make sure that they can buy housing and provide housing for rental and renters, across the nation. And so they have very competitive and attractive terms, but they ebb and they flow based on volume typically. They also have caps of how much they can lend annually. And they are very focused right now on making sure that what they're financing qualifies as true affordable housing. But typical terms that you will see through Fannie Mae and Freddie Mac are similar to the banks. They offer 5, 7, and 10-year fixed programs, although Fannie Mae will go longer and will do up to 30-year fixed on multifamily commercial properties. The rates today are not very competitive, but they will do it. Typically, you'll have a 30-year amortization schedule. However, both Fannie Mae and Freddie Mac will offer partial or full-term interest only at certain leverage points. So that can be very attractive and a differentiator from the banks. One of the major differentiators for Fannie Mae and Freddie Mac is that they're programmatically non-recourse to the borrower. And so what that means is, as an individual investor, you are not providing a personal guarantee. You are only signing what's known as the non-recourse carve-outs, meaning also known as the bad boy provisions. So as long as you do not act in bad faith, misrepresent anything, fraud, etc., you will be off the hook from signing a personal guarantee. And that is very attractive to multifamily owners and very attractive to syndicators who are putting deals together and working with pools of other people's equity money.
I was going to ask a little more about that before we go on, because I think there's a lot of people that are interested in syndications and funds and stuff like that. And I think what you do is kind of perfectly suited to that type of thing.
Mm-hmm.
So like, let's say you're listening today because you want to put together a syndication and you're going to be the sponsor, the general partner, and then you're going to go out and raise funds from limited investors, and you're going to buy a piece of property, right? I'm sure people have a lot of questions about what the requirements are for that. So we know that you can do it non-recourse, which is fantastic, right? To shield your limited investors from liability. But for people looking to do that, is there a minimum equity contribution from the sponsor? Do they underwrite the sponsors? Do the limited investors have to be packaged on the loan? What's that process look like if you're trying to, say, put together your first syndication?
Yeah, all great questions. And let's sort of break it down. So Fannie and Freddie, as opposed to the banks and the credit unions, which oftentimes will look to the sponsor as a secondary source of repayment, they're really just making sure that they have the financial wherewithal to really run this project. And so what they typically look for is a minimum total net worth and a minimum post-closing liquidity amount. And so I give typically a ballpark that I say is you want of your loan amount, you need 2x total net worth. And of that, 10 to 20% should be post-closing liquidity held in non-retirement accounts. So just for an example, if you're taking on a $3 million Freddie Mac loan, at minimum, as the sponsor, they would require a $6 million total net worth. And of that, they would likely want 10 to 20%. So 600,000 to 1.2 million in post-closing liquidity shown on your balance sheet.
So you can't just go out and buy $100 million development for your first syndication and sail through underwriting.
Correct. Now you can, but you likely wouldn't be the sponsor. You'd have to take on a partner, a Marty, for example, that's been in the business for a long, long time, has a great resume, balance sheet, and they may actually be the sponsor. You can put the deal together or be a co-sponsor, et cetera, but you'll need that. And especially right now, and it's been highlighted by the pandemic, experience more than ever means a lot. And it's real, true ownership experience. And that's separate from property management experience. And so I stress that because there are a lot of folks who have forayed into commercial multifamily through property management. They have a portfolio that they manage of 1,000 units, but they only own 40 units. And so when the lenders boil it down, though, they look at the 40 and not those 1,000.
Got it. Very good.
And so just to answer the last piece of that question for you. So minimum equity from the sponsor. So Freddie Mac technically does not have a minimum. And so you could put your investors probably want you to have skin in the game. So I'd advise you to put some in, but we've done deals where the sponsor has put in as little as 1% of their own money into a syndication, right? So that means 99% of the equity stack they've raised elsewhere. Fannie Mae is a little bit different because we are what's called a delegated underwriter servicer. And so what that means is so long as a loan checks all the boxes, we are the credit decision makers, and we do not have to ask anything of Fannie Mae. And so we actually set a limit. Typically it's 10% sponsor equity when we're going Fannie. But again, that can vary lender to lender based on their risk tolerance. We tend to be fairly conservative with Fannie Mae, despite the fact that we do so much volume. We're the largest Fannie Mae lender in the country, as I mentioned, but it's been very good to us. And so if it ain't broke, don't fix it. So a little bit different between the agencies, but again, very competitive. And ballpark rates today, probably low to mid threes for 10-year fixed rate money. 60 days ago, 90 days ago, we were in the high twos still. So there's been a run up in treasuries, but if the deal is strong enough, you could probably still get high twos on 10-year money today.
Nice. And then what do prepayment penalties look like?
Great question. So Fannie Mae is a little bit more flexible than Freddie Mac. With Fannie, you can sort of customize it, but you just pay a premium. But off the rack, both agencies offer what's called yield maintenance. And yield maintenance is, it's a little complex, but the easiest way to think about it is if you were to pay off your loan halfway through the loan term, the lender would receive those dollars and want to reinvest them to get the same yield by buying US Treasury bonds, essentially. And so they are going to charge you, especially US Treasury bonds being much lower than the yield that they're getting from your loan and the interest that you're paying them. And so they're going to charge you the equivalent of that. And so it can get very expensive. And it can also be hard to predict because it's also a function of where US Treasury rates are at the time you pay off. And so it really locks you into your loan, and it can be a very inflexible structure. So those seeking flexibility or they don't exactly know when they want to sell or refinance potentially based on their business plan, I would highly recommend that you look into bank or credit union executions that offer prepayment flexibility, or or you pay up the premium with, say, a Fannie to get that, to unlock that, because again, it can be very inflexible.
Awesome. Thank you for the explanation on that. Okay, so now that we have a general idea of the cornucopia of lending options between everyone here, let's talk about what the heck happened in 2020. So maybe we'll go to Tommy first on this. So rewind to a year ago today to where we are now. Why are we seeing what we're seeing in your space?
Gotcha. So yeah, just a quick overview of that. So when the pandemic initially came out, rates actually went up in the first probably couple weeks of it, maybe even a month of it. Rates went up pretty heavily with the announcement of forbearances and all these different things that these homeowners were able to take advantage of. Investors didn't want to buy a bond, didn't want to buy a mortgage-backed security at all. They were selling them as fast as they could because they wouldn't be performing. You know, people would be buying a mortgage-backed security to not receive payments while these homeowners, borrowers were going through the forbearance process. As that kind of took shape and the Federal Reserve took note of that, they started purchasing mortgage-backed securities specifically to artificially lower the interest rates to spark lending, refinancing as a major piece of the economic movement at the time because the rest of the country was shut down. So they are purchasing $120 billion a month in mortgage-backed securities specifically, which took rates from upper threes, low fours on multifamily stuff, investment property 25% down to the twos. You saw 30-year fixed rate loans on primary mortgages for owner occupied get to 2.375 with no points. Got close to 2.25 even at one point. Now, and that kind of took place all the way through 2020. Rates were in the low or the mid twos, and on a non-owner occupied, they got down to the low threes, like 3.125% for a 30-year fix with no points. And they stayed steady there from about July, August timeframe. That's about the time it took from March to July or August for the rates to kind of trickle down to that point from where they were before, all the way through the end of the year. 2021 came in, obviously some policy changes, some different economic approaches, and we're starting to see rates move up. We've seen rates move up pretty much on all of our coupons about 0.5%. And the reason for that is forbearances in the residential space anyways. The reason for that is forbearances have been extended. And so that has made bond traders want to not buy bonds again because forbearances have been extended out to application dates through June, which gives the borrowers ability to not have to make payments through the rest of the year. And so what's happening with the overall average investor that's purchasing out there to purchase bonds or a pool of bonds, they've lost the appetite for it. And so that, accompanied with some economic policies, has raised inflation. Everybody's starting to see that. You see it in gas prices, grocery store prices, things like that. But specifically gas prices, you've seen the tick up in the cost per gallon pretty heavily over the last 60 days. And the biggest nemesis to interest rates is the term inflation. They hate it. And we're seeing a run up, as Andrew alluded to. We've seen a run up on the 10-year Treasury. That kind of goes synonymous with interest rates. When we see that yield go up, rates are on the rise. When we see the yield for the 10-year Treasury come down, rates are reducing along with that. So we're in a little bit of a knee-jerk market up until about a week and a half ago, and I think rates went up about 0.5% in my space in about a 2.5 week period is all it took. We've kind of flattened out now, and I think the market's kind of waiting to see and kind of in a wait and see mode on what's the next step. What are we going to do? What's the stimulus package look like that Congress just passed, and how is that going to affect the regular borrower's ability to make payments? Awesome. And so that's kind of where bond investors are looking at right now, and kind of in a wait and see mode. And that's where we're going to kind of see where interest rates go from that point forward.
Interesting.
The overall market is still manipulated by the Federal Reserve. Clearly, they can't allow interest rates to go up too much too quickly. That would have a stifling effect on the overall economy. If that came to fruition, they would probably end up buying more bonds to try to artificially bring rates down a little bit as well, which gives you some long-term hyperinflationary risks and stuff like that. But we've been in a Federal Reserve manipulated market since 2010 for the most part. So I think they've got kind of a good game plan on that internationally as well, because the international markets are so messed up. As it makes that U.S. bond market usually historically the safe way to park your money, and that has helped and probably will help interest rates stay good in the future. We are, like I said, we are in an upward moving market now. We're kind of waiting for the other shoe to drop and really see what the stimulus package is going to do and have the economic effects to that. And that will kind of determine where the rates go from here, whether they stay where they're at or they go up a little bit or come back down.
So let's talk about forbearance. You mentioned that for a minute, and we are kind of running out of time. So maybe for David and Andrew, when I go to you after this, we'll talk about what happened in 2020. Everyone's want to know what's going to happen, like probably in the next quarter or two, right? And you can see, it seems like there's a lot of misinformation out there in the market about this, there being a wave of foreclosures coming because forbearance is all coming due. And you see some people that say, well, it's not, it's added onto the end of the loan. And then I've heard some people say, no, that my bank's asking for that from me right now. Tell me what's going on there. Is that true? It's hard to know what to believe.
Yeah. So, well, to touch on that, a wave of foreclosures, I just don't see that happening. I think the markets are too manipulated. And these forbearances have basically allowed borrowers to not make payments on these loans. And the reality of it is Fannie and Freddie, which is the majority of the multifamily loans, about 93%, I think, of all 2 to 4 unit loans in the residential space are Fannie Freddie products, right? So you're subject to their guidelines. They allow banks to take whatever missed payments. So if you went into forbearance for 3 months and you missed a total of $6,000 in payments over that 3-month period, they are basically giving you a secondary trust deed that you will sign, and they will just push those payments for that $6,000 that you missed to the back of the loan. So if you were just in a 30-year fixed and you went straight into forbearance, you're going to be making payments on that for 30 years and 3 months, essentially. That move in itself is going to kind of stay off the foreclosures and things like that. Fannie and Freddie do incentivize banks to recoup that capital faster. So if somebody works out a forbearance agreement and pushes those payments to the back of the loan, Fannie and Freddie incentivize that bank to do that workout plan for them. So they'll give them money for that. The shorter the workout plan, the more money that bank gets from Fannie and Freddie. So remember, if you go into forbearance, you're now dealing with a debt collection situation with the bank. There's going to be a loss mitigation team that you will talk to that will walk you through your options of reinstatement. And when they walk you through those, they're going to want to recoup the missed payments as quickly as they can. And if they can get, like I've had clients of mine where they've had to make up 3 missed payments over the next 3 months or 6 months, sorry. And they'll have to make half of the payment that they missed, each month going forward so that they're made whole at the end of that 6-month period. And now the loan is performing again and back up to its regular amortization schedule. If the bank can work out a plan like that with the customer, they get even more money from Fannie and Freddie than they would had they put it on the back end. But it is a negotiation at that point between you, the consumer, and the bank. The bank cannot force you to pay those payments over the next 3 to 6 months and make up anything. They want to get more capital, but they can't force it.
More complicated than it sounds. So
Right.
we're starting
Also, real quick, can I just touch on that for anybody? A lot of people, there's a misconception about forbearances and that there's no, like you just take the forbearance and then go refinance or go buy another home or whatever. That is not the case. Forbearances, if you go into a forbearance and you miss even one payment, Fannie and Freddie's guidelines are if you wanted to refinance and take advantage of the rates, you would have to get out of forbearance, reinstate the loan, and make 3 on-time payments, which cannot be prepaid. any longer. Initially, you could prepay those. Now you have to make 3 on-time payments before you're even eligible to close a refinance, not to do an application, but to close a refinance. And so there's some ramifications about going into forbearance. It's not just the banks will punish you and limit your ability to finance. And real quick, and we haven't touched on jumbo loans, but for any jumbo borrowers that are out there, if you go into forbearance, jumbo guidelines came out just 2 weeks ago, and they look at that as an adverse credit situation now. And so you cannot do anything, just like what they did when people went into short sales. You cannot do anything on a jumbo loan for 4 years. No matter if you make up your payments, you just missed one and you made it up the next month, doesn't matter. You went into that forbearance. If you accepted that forbearance agreement, by the time when you get reinstated, you're a 4-year waiting period before you could get a jumbo loan, not an FHA or conventional, but a jumbo loan.
Got to be careful. All right, guys. So I'm going to take some time from the networking section that we had slated to go after this, because I'm really interested in this topic from David and Andrew as well. So if you can concisely as possible,
Sure.
What happened in 2020? Where are we going? What happened with forbearance? Where are rates going here through the end of 2021? David, I'll give it to you next.
Yeah, the individual banks didn't have as much, support from the Fed buying back those bonds. So they were worried when they got a huge influx of forbearance requests in the beginning of, the spring of 2020. They were more worried about protecting their own loans and protecting their own balance sheet and their deposits. So what they did was immediately put a halt on lending, or as much of it as they could. And so like within 1 day or 2 days, most of the banks raised their rates 120 basis from 3.5 to 4.5 or 4.85. And basically the point, they also shortened made stricter their underwriting requirements. And basically the point of it all was just to stop lending. And they basically did that for a good 4 or 5 months. And then towards the end of the summer, things started to open up as it looked like things were going to stay stable and people were collecting their rents. And so once there was a little bit of confidence back in the market, banks have come back and have been really busy since. We're still a little bit lower on maximum loan to values than we were in the past. So right now we're seeing like 65, 70% loan to value on most of them, most banks. And then some credit unions and some banks are offering the 75, just like before. For the most part, banking is back to where it was, maybe a little bit more conservative, but looking forward, we see probably rates. If I had to guess, I'd say they'd probably creep up 10 to 15 basis points in the next quarter. So instead of looking at, a rate around 3.25 to 3.5, you're looking at 3.5 to 3.75. And so I think that's probably what we're looking at. Banks are really, really busy right now, and credit unions are really busy. So there really isn't no incentive to get more aggressive. Treasuries and the swap rates seem to be creeping up as well. And so I think we'll see rates climb a little bit. But at the same time, banks might also get a little more aggressive and fully come back to where they were before COVID. And so we might see underwriting guidelines loosen up a little bit and banks get more aggressive to compensate for the slightly higher rates.
Awesome. All right. Thanks. Andrew, what happened? Where are we going?
Perfect. So, listen, as was the case with a lot of industries, there were winners and losers in the pandemic, right? And so I think a huge part of the story in 2020 and what we're seeing now in early 2021 and Q4 2020 was there was a pent up demand for stable and safe haven assets like multifamily properties, which have clearly been a huge winner throughout this cycle. A lot of buyers sat on the sidelines from March to September because of the volatility, the unknown of the virus. And even though debt was available, right? I mean, some lenders sat out completely. We continued lending. In fact, we had a record year for transaction volume at 41 billion for us. But almost 65% of that was refinance business because acquisition volume, investment sales was so down. Quick figures, 2 years ago in 2019, the US was averaging 40 billion a quarter in multifamily investment sales. In Q1 of 2020, we hit 35 billion. Because the market was firing until it stopped in mid-March. In Q20, there was only 12.5 billion. In Q3, about 22 billion. And then in Q4, buyers said enough is enough, and we hit 45 billion. It was just under the highest peak we've ever had, which was in Q4 of 2019. So it's a super competitive landscape. that we're in today. And that tells me that all investors are now chasing multifamily over other asset classes. So you have folks that were investing in hotels, retail, office, they've all pivoted and now they're bidding on multifamily, and you're competing against that. Forbearance, I'll speak from just Fannie and Freddie. I don't know the exact numbers, but through sort of Q3 of last year, Freddie had forborne about 1.9 billion in loans, while Fannie had only given out about 400 million. The speculation there was that Freddie's small balance loan portfolio really bore the brunt of those requests. So again, we're talking about winners and losers. My opinion is smaller investors who weren't very diversified, who own smaller properties in rural markets, were impacted disproportionately by the pandemic. Is there a wave of foreclosures coming? In my opinion, no. We've had very little forbearance in our $100 billion servicing portfolio. And you have to remember, multifamily has earned its reputation as a defensive investment, right, in times of economic weakness. Since last March, rent collections have held firm above 90% nationally, and the national vacancy rate is only 6.8%, which isn't that much higher than it was in Q4 2019 at 6.2%. So delinquency rates are below 4%. And yes, in major metro, San Francisco, Manhattan, rents have fallen, but based on our analytics, 62 of the 80 largest markets continue to have positive effective rental growth through Q3 of last year. So people are just moving into bigger units in more suburban communities. Think Sacramento outside of the Bay Area, and Northern New Jersey and Long Island City outside of Manhattan. Right. Where are we going? Gosh, I hate speculating on rates. Look, if you can get 3.5% fixed on a 10-year deal, I should be on the cover of Mortgage Banker Monthly magazine. Rates are going up. We're at historic lows. How can they go any? Like we've been saying this for 10 years, it seems like. But in my opinion, they have to go up. They will go up. They will go down, but mostly up. And you should be planning for that, right? All of your pro formas for investors, take that into consideration. Build in a stress factor that says rates will be going up to be conservative. If it doesn't, great, but it probably will. So just do it. And the only other thing I'd say is, I think over the next 2 to 3 and longer term, the only guarantee is that technology will disrupt this industry. We've already done it. We've launched a service called Apprise for multifamily appraisals in certain metros that can turn a multifamily appraisal around in 5 days. This is a dinosaur industry. Tech will infiltrate, and it will change the game, hopefully, and for the better, and make it a streamlined process for investors and borrowers to do more business, and us to put more debt out to them. So that's my thoughts in a nutshell.
So great, gentlemen. I know we had a limited amount of time. That was a tidal wave of information about finance, from everything from owner-occupied duplexes to $1 billion deal, right, with Andrew. So very interesting stuff. We put all of their contact information and downloads on the page for this session. These guys are who we use to do all of our deals. So if you're looking to finance stuff, you want to refinance, you want to purchase, obviously that's why they're here. They're some of the best in the business. I encourage you to reach out to them depending on whatever space that you are looking in, and check it out. Thank you so much for sharing your expertise with us, gentlemen.